$2,187,000. Only $112,800 of it was ever deposited. The other $2,074,200? No salary paid it. Nobody gifted it. Nobody earned it in a single trade. Time built it. Compound interest built it. That is the power of staying growth-oriented while time is on your side. But the allocation that builds wealth at 18 can destroy it at 55. Most people never see that number, not because they did not earn enough, but because nobody ever gave them the allocation rulebook that actually works now. Here is what nobody tells you. The rules most people learned were built for a different retirement world: higher bond yields, shorter retirements, and less pressure from longevity. That world is gone, and a portfolio built for that world may underperform in this one. What I am about to give you is a baseline glide path, a starting framework, not a personal prescription. Your exact percentages will depend on your income, your goals, your risk tolerance, but the principle underneath every age bracket, that is universal. The wealthy do not follow one allocation their entire lives. When time changes, the math changes. Let me show you exactly what that looks like, age by age, chapter by chapter. Age 18 to 22. You are at the starting line. No savings, no 401k. Maybe you are in school, maybe your first job, and the single most valuable asset you own is not your degree or your skills. It is your age. The allocation, 100% stocks. You have 43 to 47 years before you touch this money. A market crash in your early 20s is not a threat. It is a discount. Every share you buy cheaper compounds for 4 decades. Here's the math. $200 per month. Age 18 to 65, 47 years. At 10% annual return, roughly the historical stock market average, that $112,800 becomes approximately $2.19 million. At 6%, a more conservative bond-heavy return, that same money becomes roughly $594,000. Read that again. Same deposits, same timeline. The only variable? Where you put it. That is a gap of nearly $1.6 million. That is what being careful costs you when you should have been aggressive. One total stock market index fund. Automatic monthly deposits. Do not touch it. Age 22 to 25, you graduated. First real job. Income is low. Obligations are multiplying. This is where most people make the costliest mistake of their lives. They stop investing. I will start when I earn more. That sentence has destroyed more retirements than every recession combined. Allocation, 100% stocks, still 40+ years. But the goal shifts from just investing to increasing what you invest. If you started at $200 and bumped to $300 at 23, your ending portfolio moves from roughly $2.19 million to roughly $2.86 million. That extra $100 per month added about $670,000. Every dollar invested at 23 could become roughly $55 by age 65. Every dollar invested at 45, less than $7. Same dollar, same market. Time is the multiplier. Your 20s are not the years you make money. They are the years you buy compound interest at a discount. Age 25 to 30, income rising, lifestyle expanding. The biggest threat to your portfolio right now is not a bear market. It is your social circle buying things you suddenly want. Allocation shifts for the first time. 95% stocks, 5% bonds. Why 5% bonds? Not for returns, for behavior. When the market drops 30%, your portfolio drops roughly 28% instead of 30%. That tiny cushion keeps you from panic selling. It is not math. It is staying in the game. If you have been investing $300 per month since 18 through age 30, your portfolio is roughly $78,000 to $83,000. 12 years of deposits and compound interest is already pulling harder than your contributions. At 28, someone will tell you to take some profits. Ignore them. You have 35 years left. A 28-year-old getting conservative is a marathon runner walking the second mile. Age 30 to 35. Life gets expensive. House, children. Your expenses have doubled since your 20s. Do not pause. Adjust. Allocation. 90% stocks, 10% bonds. You still have 30 to 35 years. Stocks still dominate, but that 10% bond cushion now serves a real purpose. A job loss at 33 with a mortgage hits differently than one at 23. Here is what happens at 33. Someone stops investing to focus on the family. They promise to restart at 40. Those 7 missing years, $300 per month, could cost nearly $390,000 by age 65, and that assumes they restart. Most do not. Even if you drop from $300 to $150 per month, keep contributing. The habit matters more than the amount. The system does not care about your circumstances. It only compounds what you give it. Age 35 to 40. For the first time, your portfolio feels real. If you started at 18 and increased contributions, your balance sits between $200,000 and $300,000. Your portfolio is now earning more per year from compound interest than you deposit. That inflection point is what separates people who retire wealthy from people who do not. Allocation: 80% stocks, 15% bonds, 5% cash. Still growth-oriented, 25 to 30 years remain. The difference now is that 15% bonds and 5% cash give you a genuine buffer. A 40% market drop costs you roughly $24,000 less on a $300,000 portfolio. That is the difference between staying calm and panic selling. At 38, rebalance. But here is a better rule than every 5 years. Check annually. Rebalance only when an asset class drifts more than 5 percentage points from your target. Stocks at 87% instead of 80%. Sell some, buy bonds. Stocks at 82%. Leave it alone. Small drifts are not worth trading costs or taxes. Age 40 to 45. You have lived through multiple market cycles, crashes, recoveries. You have watched friends panic sell and coworkers swear off investing forever. And you are still here. Allocation: 70% stocks, 25% bonds, 5% cash. 20 to 25 years remain. You still need growth. Inflation will gut purchasing power over 2 decades. If bonds and cash remain stable, a 40% stock decline could reduce the full portfolio by roughly 25 to 28% instead of 40%. The 42-year-old who panics and the 42-year-old who stays invested see the same market, same age, same numbers on the screen. The difference is, one has an allocation they can live with, and the other is reacting to fear in real time. Your allocation is a contract with your future self. At 42, you find out whether you signed a real one. Age 45 to 50. Halfway. If you started at 18, gradually increased your contributions, and stayed consistent, your portfolio could now be somewhere between $500,000 and $850,000. That number should comfort and terrify you simultaneously. Comfort, because you built something real. Terror, because 15 to 20 years of decisions remain, and every one of them matters more now. Allocation: 60% stocks, 35% bonds, 5% cash. The most balanced portfolio of your life. 60% stocks for growth, 35% bonds for stability and income, 5% cash to reduce the chance of selling stocks in a down year. The trap at 47 is lifestyle inflation. Income peaks, house gets nicer, vacations get longer, contributions stay flat. On a $100,000 salary, increasing your savings rate from 12% to 18% means investing an extra $6,000 per year. Over 18 years, at a hypothetical 10% return, that could add roughly $280,000. The 47-year-old who stays at 12% retires with less than they need and does not realize it until 63. Age 50 to 55. Retirement is no longer abstract. It has a date. The question shifts from how much can I grow to how long will this last? Allocation: 50% stocks, 40% bonds, 10% cash. For the first time, stocks are not the dominant position. Half still grows. The other half preserves what 4 decades built. That 10% cash covers roughly 2.5 years of portfolio withdrawals at a standard 4% rate. If the market crashes the year you plan to retire, you do not sell a single stock. The mistake at 53: getting too conservative too fast. Shifting to 30% stocks because retirement is coming. At 30% stocks, your portfolio barely outpaces inflation. Over 12 years, $1.3 million at 65 buys what roughly $910,000 bought at 53, assuming 3% inflation. That is not safety. That is slow motion loss. For this baseline, 50% stocks preserves the growth you may still need. The bonds and cash are your seatbelt. The stocks are your engine. You still need both. Age 55 to 60. Final accumulation decade. Your portfolio's job has shifted from growth to endurance. Allocation: 40% stocks, 50% bonds, 10% cash. 40% stocks fight inflation for 30 more years. 50% bonds generate predictable income. 10% cash is your first line of defense. Now we address the thing that destroys more retirements than crashes: sequence risk. You retire with $1.2 million. The market drops 35% in year 1. You still need $50,000 to live. You sell at the bottom, $50,000 in shares that were worth $77,000 6 months earlier. Year 2, same. By year 3, recovery becomes much harder, even when the market eventually rebounds. Cash alone covers roughly 2.5 years of portfolio withdrawals. Bonds provide the second line of defense, giving stocks more time to recover. You draw from cash first, then bonds. You give stocks time to recover before you touch a single share. You never sell at the bottom because you never have to. That is not luck. It is allocation. Age 60 to 65. More than 40 years of the machine running. Through everything. Allocation: 35% stocks, 50% bonds, 15% cash. Why still 35% stocks at 65? The average 65-year-old lives to 83 or 85. Some reach 90. That is 20 to 25 years of retirement. At 3% inflation, a $50,000 annual withdrawal needs to be roughly $75,000 in 15 years just to maintain your lifestyle. Without stocks, that math does not work. You do not run out because you spent too much. You run out because inflation ate your purchasing power while bonds stood still. For this baseline, 35% stocks preserves a meaningful layer of long-term growth. The withdrawal discipline: spend from cash first. Refill it by trimming whichever asset is above its target, and avoid forced stock sales during deep downturns. That is the difference between dying with money and running out at 83. Age 65 and beyond. You are distributing, not accumulating. One job: do not run out. Allocation: 30% stocks, 50% bonds, 20% cash, 30% stocks for a final layer of growth, 50% bonds for steady income. 20% cash provides roughly 5 years of portfolio withdrawals at a 4% starting rate. Highly liquid, low volatility money that reduces the need to sell during a downturn. At 70, simplify. 3 things: 1 total stock market index, 1 total bond market index, and a high-yield savings account. That is the portfolio. Everything else is noise. At 75, think about what you want your money to do after you are gone. Fund grandchildren's education. Support a cause. Leave something behind. The machine kept running for 5 decades. It delivered more than you needed. That is not an accident. That is doing what the math said, even when it was hard. Look at what just happened. From 18 to 85, your allocation changed exactly 9 times. Each shift was small. 5% here, 10% there. Not dramatic, not reactive. This is a baseline glide path. Your exact numbers depend on your income, your goals, your risk tolerance, but the principle is universal. When time is abundant, be aggressive. When time is scarce, be protected. Everything in between is mathematics. The 18-year-old and the 65-year-old share almost nothing. Why would their portfolios be the same? The allocations are clear. The timeline is locked. You now know what took most people decades of expensive mistakes to learn. The question is not whether you understand the allocation for your age. The question is whether you will act today. Most people will watch this, nod, check their phone, change nothing. Drop your age and your current allocation in the comments. Seeing it written down is the first step to fixing it. Subscribe to Drawn Sense, because that is exactly what we are building here. The rules nobody tells you. One age bracket at a time. Your move.